Hello everyone, and welcome back to our first video in Chapter 17 on revenue recognition. And after going through this chapter, we're going to look at the fundamental concepts related to revenue recognition and measurement. Many of these fundamentals you already know from your beginning financial accounting courses, but there is much new information as well. And here we're going to explain and apply the 5 steps in revenue recognition. And then we'll apply those 5 steps to major revenue recognition issues. And finally, we'll describe the presentation and disclosure regarding revenue. Okay, so if I preview Chapter 17, we'll have a little background first, then revenue recognition standard, and then an example of the 5-step process. So here is the 5-step process revisited. We're going to be identifying the contract with the customers, identifying separate performance obligations, determining the transaction price, allocating the transaction price, and finally satisfying the performance obligations. We're going to take a look at sales returns and allowances, repurchase agreements, bill and hold arrangements, principal-agent relationships, consignments, warranties, and non-refundable upfront fees. And finally, then we'll take a look at presenting and disclosing revenue. Okay, we'll get into the meat of the chapter. First, we'll discuss the fundamental concepts related to revenue recognition and measurement. The FASB issued a standard on revenue recognition entitled Revenue from Contracts with Customers. And to address those inconsistencies and weaknesses of the previous approaches, a comprehensive revenue recognition standard now applies to a wide range of transactions and industries. Okay, revenue from contracts with customers adopts an asset liability approach. Companies, 1, account for revenue based on the asset or liability arising from contracts with customers. 2, they're required to analyze contracts with customers. And sub-bullet point 1, that the contracts indicate terms and measurement of consideration. And bullet point 2, the contracts specify the promises that must be met by each party. Okay, the key objective then, recognizing revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration that the company receives or expects to receive in exchange for these goods or services. And here are those 5 steps that we just enumerated. We identify the contract, we identify the separate performance obligations in the contract, we determine the transaction price, we allocate the transaction price to separate performance obligations, and finally recognize revenue when each performance obligation is satisfied. So the revenue recognition principle is that we recognize revenue in the accounting period when the performance obligation is satisfied and the revenue is earned. All right, here's an example. And to provide an application of the basic principles of the 5-step revenue recognition model, we use a coffee and wine business called Bean. Bean is located in the Midwest and serves gourmet coffee, espressos, lattes, teas, and smoothies. It also sells a variety of pastries, coffee beans, and other food products, wines, and beer. So, first step, identifying the contract with customers. Here we're going to assume that Tyler Angler orders a large cup of black coffee costing $3 from Bean. Tyler gives $3 to Bean Barista and pours the coffee into a large cup and gives it to Tyler. Question then, how much revenue should Bean recognize on this transaction? Well, step one, we must first determine whether a valid contract exists between Bean and Tyler. Here are the components of a valid contract and how it affects Beans and Tyler. Number one, the contract has commercial substance. Tyler gives cash for the coffee. Number two, the parties have approved the contract. Tyler agrees to purchase the coffee and Bean agrees to sell it. Number three, identification of the rights of the party is established. Tyler has the right to the coffee and Bean has the right to receive $3. Number four, payment terms are identified. Tyler agrees to pay $3 for the coffee. And five, it is probable that consideration will be collected. Bean has received $3 before it delivers the coffee. From this information, it appears that Bean and Tyler have a valid contract. This may seem like a very simple example, and it is, but it will get more complex, you will see, as we apply these principles in different scenarios. Okay, step two, identifying separate performance obligations. The following day, Tyler orders another large cup of coffee for $3 and purchases 2 bagels at a price of $5. The barista provides these products and Tyler pays $8. So the question is, how much revenue should Bean recognize on the purchase of these 2 items? Well, step two, Bean must determine whether the sale of the coffee and the sale of the 2 bagels involve 1 or 2 performance obligations. In the previous transaction between Bean and Tyler, this determination was straightforward because Bean provided a single distinct product, a large cup of coffee, and therefore only 1 performance obligation existed. However, an arrangement to purchase coffee and bagels may have more than 1 performance obligation. So, multiple performance obligations exist when the following 2 conditions are satisfied. Number 1, Bean must provide a distinct product or service. In other words, Bean must be able to sell the coffee and the bagels separately from one another. And number 2, Bean's products are distinct within the contract. In other words, if the performance obligation is not highly dependent on or interrelated with other promises in the contract, then each performance obligation should be accounted for separately. Conversely, if each of these products is interdependent and interrelated, then these products are combined and reported as one single performance obligation. Okay, the large cup of coffee and the 2 bagels appear to be distinct from one another and are not highly dependent or interrelated. That is, Bean can sell the coffee and the 2 bagels separately, and Tyler benefits separately from the coffee and the bagels. Bean should therefore record 2 performance obligations, 1 for the sale of the coffee and 1 for the sale of the bagels. Okay, step number 3. Bean decides to provide an additional incentive to its customers to shop at its store. Bean roasts its own coffee beans and sells the beans wholesale to grocery stores, restaurants, and other commercial companies. In addition, it sells the coffee beans at its retail location. Bean is interested in stimulating sales of its smoke jumper coffee beans on Tuesday, a slow business day for the store. Normally, these beans sell for $10 for a 12-ounce bag, but Bean decides to cut the price by $1 when customers buy them on Tuesday. The discounted price is now $9 per bag. Tyler has come to the store on Tuesday, decides to purchase a bag of smoke jumper beans, and pays Bean $9. Okay. The transaction price for a bag of smoke jumper beans sold to Tyler is now $9, not $10. The transaction price is the amount that the company expects to receive from a customer in exchange for transferring goods and services. The transaction price in a contract is often easily determined because the customer agrees to pay a fixed amount to the company over a short period of time. In other contracts, companies must consider adjustments, such as when they make payments or provide some other consideration to their customers. For example, a coupon as part of a revenue arrangement. Okay, step 4. Bean wants to provide even more incentive for customers to buy its coffee beans, as well as purchase a cup of coffee. Bean therefore offers customers a $2 discount on the purchase of a large cup of coffee when they buy a bag of its premium mocha beans, which normally sell for $12 at the same time. Tyler decides this offer is too good to pass up and buys a bag of mocha beans for $12 and a large cup of coffee for $1. As indicated earlier, a large cup of coffee normally retails for $3 at Bean. Okay, so Bean then allocates the transaction price to the two performance obligations based on their relative standalone selling prices. The standalone selling price of a bag of mocha beans is $12, and the large cup of coffee is $3. So here you see we put those in for a total of $15 and assess these percentages, and then multiplied it times the transaction price of $13. Very similar to the way we did lump sum purchases for real estate. So, as indicated, the total transaction price, $13, is allocated at $10.40 to the bag of mocha beans and $2.60 to the large cup of coffee. Okay, Bean is satisfied with the performance in step 5 when Tyler obtained control of the product. Change in control is the deciding factor in determining when a performance obligation is satisfied. A customer controls the product or service when a customer has the ability to direct the use of and obtain substantially all the remaining benefits from the product. So, control also includes Tyler's ability to prevent other companies from directing the use of or receiving benefits from the coffee or coffee beans. Okay, we'll move now into our next objective, explaining and applying the 5-step recognition process. And here, step 1, the contract. That's an agreement with 2 or more parties that creates enforceable rights or obligations. And it can be written, oral, or implied from customary business practice. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at this contracts and recognition example. Until then, bye for now.